Yo, that got me fired up. Can we get another round of applause for the previous panel, the diversity panel? I'll tell you what, like, there was something they brought up about teams, and you have to go search out diversity for your team. And I know that I personally have had the experience where I'll be building something and I'll just kind of look up one day and I'll be like, oh shit, like my team is all dudes. So I totally feel that. And with Web3, right, the promise is that this is something where we all win at, right? This is like a community wins, everybody wins situation. And we all have to remember that not everyone is truly winning if we don't have diversity. So, like, I don't know, always thinking about it, you know? So, anyway, the next panel is about stablecoins. We all know them, we all love them. We're all afraid of them sometimes. I am. But I love them, and I need them. So, we're going to have Bill, and there's no names on here, but Bill Carter, and we're moderating by your boy, Jonathan. Give it up.
What's up? Hey, how's everybody doing? Good morning, good second day. Everybody doing all right? Yeah, all right. So we're going to be talking about stable coins this morning. Before we get started, my name is Jonathan G. Blanco. I am the founder of Niftmint. We do NFT commerce infrastructure for brands. I'm also the founder of TF Labs. We're a Web3 startup studio. I'm a big fan of the stable coin space because I think there's a lot of utility needed behind it. I do think it's misunderstood on how that works too, and I think it also makes other things, stronger as well. So I'm really excited to dig into this panel. So why don't we just get into some introductions, and then we'll go ahead and get started with it. Carter, how about you first?
Yeah, 100%. Carter Wetzel here, been in the space since 2017. Ever since MakerDAO, ever since the inception of stablecoins, it was very clear that we needed to have a product that didn't have volatility that we could bring to everyday consumers. So, published author, spent 3 years writing a book, and kept falling down the stablecoin rabbit hole, kept wanting to build something more than just a dollar stablecoin. Helped pull together an awesome, amazing team with Shade Protocol and Silk, and that's where we are today. So,
hi everybody, Bill Noble from Token Metrics. We do AI along with research by humans. I'm the host of a show on YouTube called The Market Update, where I basically tell you a little bit about what's happening now and hopefully accurately tell you what's going to happen next. So I will help my friends here with stablecoins by trying to maybe talk about the collateral underneath it. I've been in this space since 2017. I made a successful escape from Wall Street.
Congratulations.
Thank you.
I was on a panel with Mark Yusko yesterday, and he was talking about just all the talent that is migrating, call it from traditional finance and traditional, points of tech onto Web3, and that's a really encouraging thing, right, that, all of you in this room here. So let's just level set the conversation really quickly. We're not going to spend a ton of time on this, but, like, what is a stablecoin? Actually, we're going to spend the whole time on this, but...
So in essence, a stablecoin is a digital asset that maintains its value. You have Bitcoin that can go, from 30K to 60K, and you have all this crazy volatility. And the dream of a stablecoin is, can we build something that is collateralized and doesn't have volatility, such that we could use it in our everyday lives. We can use it for payments and transactions, and it makes a lot more sense to use a payment system with the currency that actually is stable. Right? It's kind of in the name.
All right, so as a technical analyst, what's a stable coin? A stable coin is something that you have faith and believe will stay around 1 or 1.05 so that you can use it to buy things, right? In the current world, you take a piece of paper backed by a government and exchange that for goods and services. So paper for a television. A stable coin is the same thing. Except there's no government, there's faith and collateral, and you exchange that for Bitcoin, or you want to go shopping for a blazer in the metaverse.
I would say there is government, though, because there are, government, CBDCs that are coming out. They're, if you, depending on how you're collateralizing it, if you're collateralizing it against the U.S. dollar or so forth, there definitely is government in that regard as well, of course. But look, there's JP Morgan coin is a stable coin, and when you start thinking about it from a banking context, what we're really talking about is in-network currency for a bank, in-network currency for institution, organization, and then cross-border payments. You're talking about settlement, faster, quicker settlement layers, et cetera. And so, if someone can send, even in you're talking about you came from Wall Street, even in a traditional finance context, if you wanted to, I don't know, purchase from the Swiss stock exchange, and you can, transfer via stablecoin versus doing a Swiss franc to U.S. dollar exchange and waiting a couple days and doing all these sorts of things. So, when we start to think about stablecoins overall, I guess let's just start with that. Let's start with, call it CBDCs. How are you all seeing that being used? What are your thoughts on that? I have my thoughts on it. Love to hear what you all think first, and then we'll just kind of go through segment by segment of what this space is all about.
Sure, Bill, do you want to kick us off here?
Sure. So CBDCs, a government, because we all know how well governments do things. A government is going to build a blockchain and move things around, okay, and they're going to control it. So can they build it? I doubt it. So what they're going to do is, okay, they're going to call up Carter, and they're going to say, hey, Carter, can we run our central bank digital currency? Like, I don't know, we could call it dollar coin. So maybe instead of everybody applying for unemployment or Social Security, we can just airdrop them dollar coin. Now, Carter may really want to get that call because I'm sure that would be great for his blockchain and all of his friends out here in the front. Okay, but for a central bank to successfully issue a usable currency, they are going to have to use a private sector blockchain. And like I said, because we're hanging out today, if Carter wants that business, I hope they call him.
I hope they don't.
Hope they don't.
I hope they don't.
I hope they don't.
I think like the whole ethos of Web3 and why we're all here is to build decentralized systems, censorship-resistant systems, and CBDCs represent the exact opposite end of that paradigm. And I think that is the beauty of stablecoins, is that they're globally transmittable. You have true ownership of these digital assets in a way that is extremely powerful. We had members of our community during the Ukraine crisis that there was actually max amount of money that they could pull out of their bank accounts during the crisis. And they said, like, in that moment, the only thing they truly owned, as ludicrous as it sounds, was like crypto. And it's something that no one could take from them. And all they needed was their ledger and their seed phrase, and they can go anywhere in the world. And no government can take that from you. But they can freeze an on-chain transaction. So that's why we need decentralized currencies, because we're trying to create robust systems that ultimately say we can't trust people. We want to trust math. We want to trust economics and create a fair playing field. And that's the beauty of decentralized stablecoins.
Yeah, so I would love for you to break down a decentralized stablecoin, because I'm skeptical towards those two words being paired together. Because everything that you described sounds really interesting in a Bitcoin context, or sounds pretty interesting perhaps in an Ethereum context, but most stablecoins are in fact centralized. So do you want to, I guess, dive a little bit deeper into what you mean when you say, I guess, those two together? And perhaps I'd love to learn something new if I'm not aware of that being together.
Yeah. Well, is there anything we want Bill to jump in on this too, or is this specifically directed at me?
Well, just because you brought it up, that's the only reason I was asking.
Yeah, so it's interesting because there's lots of different models for stablecoins. You have things that are very algorithmic, like Terra, which were unfortunately it's a very big experiment, right? Less collateral involved, it kind of fell apart. And then you have on the opposite end of the spectrum really over collateralized models like DAI with MakerDAO. And the question inevitably becomes, what are the assets and how decentralized are those underlying assets? If your stablecoin is backed by USDC and USDC is centralized, then you're just kind of like, it's kind of fake decentralization. And so in perfect fairness, this vision of truly decentralized stablecoins, we have to be super selective about collateral that's backing these systems. And that's one of my fears in the industry is everyone is so focused on liquidity and these, Tether and USDC. It's like such a convenient tool, but there's danger to that. And so to have truly decentralized stablecoins, we need decentralized collateral, which would be like Bitcoin, Ethereum, a lot of the Cosmos L1s, like those types of volatile assets. Use them in an over-collateralized system to create a truly decentralized stablecoin, and then use those decentralized stablecoins to be building blocks for more dynamic stablecoins is kind of the way I'm thinking about it. It's a tough problem, though, 100%.
No, it's interesting, and I'm glad you brought that down, right? Because as you were saying a moment ago, most stablecoins are backed either to fiat currency, basket of currencies, USDC, et cetera. So those are, of course, not decentralized. Decentralized is probably, or decentralization is the most overused, incorrect word in this space. There's great intention behind it, of course, but I think, from my context, I think that's one of the reasons when I hear about a central bank digital currency, I can totally understand why a government would want that. It makes if I'm a product manager, so I always wear that hat. So if I'm a product manager of the United States government, of course I would want a central bank digital currency. It makes it a lot easier. I can track money. Is that good for, average citizens? I don't know. I'll let other people decide that. But as a government, I can understand why you might want, to do that overall. That for me is why I am also very personally interested in Bitcoin, is the fact that I can kind of opt out of that. And so it sounds like what you're saying in the stablecoin, decentralized stable currency is you kind of have a little bit of access in that Bitcoin context, I guess, but without or other decentralized, but without fully being in that. Am I understanding that properly?
Yeah, that's a good summary.
Cool. Bill, you want to chime in on anything here?
Sure. So when I studied decentralized stablecoins, right, the first question I asked is, well, what about the collateral, and what happens if the collateral moves, right? So obviously the Luna example was dramatic, and now everyone's down on stablecoins, and if everybody thinks the same thing, it's wrong. So there are stablecoins out there that are good. How do we know if they're good or not? Well, how good are they at risk management? They're almost like little, they're almost like little hedge funds inside the stablecoin, right? So now you're like, well, Bill, what are you talking about? Well, in 2008, if you said, I'm going to put my house up as collateral after a real estate mortgage blow up, people would be like, oh my God, I'm not touching that. Now, if you said today, hey, I'm going to put my house up in Austin as collateral, they'd be like, oh my God, dude, we'll give you all the money you want. So the decentralized protocol, if they can figure out how to manage the fact that value is a perception, the collateral or the index it's pegged to may change, whoever figures that out, and that's a math problem, but whoever figures that out is going to win.
And I'd add that too, that, and 100%, it's interesting. There's a lot of risk management in these systems. And the way I think about it is assets, there's three types of relationships. There's correlated, uncorrelated, and inversely correlated, right? So, and I think in the stablecoin space, we've stuck with, we need to find a way to get inverse correlation to help protect the system. And we also need uncorrelated assets to help, build more, robustness into the stablecoins themselves. Right now, everything's correlated, right? It's this whole crypto backing crypto, and it's a macro market, right? And it all kind of shifts together. So I think as stablecoin builders, we have to be really challenging ourselves on how to introduce those other two components, uncorrelated and inverse correlated, because that's ultimately how we hedge and add even more stability, while still having more dynamic growth mechanisms. Like over-collateralized models, they're safe, but they're really, really struggle to grow. And that sweet spot is going to be somewhere in the middle with risk management. But then, of course, the challenge always goes back to the liquidity of the uncorrelated and the inverse correlated mechanisms.
Right, and then on the human angle, right, it's also, it's almost a marketing thing, right? Like, if you got the math right, can you communicate that you got the math right and make that believable. Like, here's the good news, I think, for your group. Like, I don't know the math the way you know the math, but I went to talk to your guys, and I watched an interview with you, and I'm like, all right, I understand what these guys are saying, right? And that means more sophisticated hedge funds will probably most likely understand it, right? And then once the smart money adopts it, retail eventually follows. So the good news about, Carter's group, if you're interested in stablecoins, is that, all right, I'm in crypto, but I'm 52 and I figured it out. And if I can figure it out, honestly, so can you and everybody who's listening.
Yeah, I appreciate the compliment for the team. It's incredible community and incredible group of builders. And yeah, storytelling is super, super important. Sometimes we think about accessibility purely from can I acquire the cryptocurrency? But also there's accessibility of the storytelling and the concepts. And stable coins are supposed to be one of the simplest stories to tell. But then you have 50 billion protocols go to zero, and suddenly that storytelling gets really, really confusing. So it's education has to be at the forefront. I think any sort of lead community member, that's where your heart has to be first and foremost. Even as a builder, that's got to be a huge percentage of your time is just simplifying this, but also communicating the nuance to the people that need to understand the nuance. And stable coins in the long run, like Silk, it's tied to a basket of global currencies and commodities. The narrative we're really, really focused on for mom and pops is you're getting inflated away right now, 8 to 12%. You could just hold this stable coin. You don't have to do anything. You don't need to put it in DeFi, and you're protected. That's the story, and I think we're gonna see more of those stories emerge. So
hold on, I want to dive into that because something's not computing for me. So if it's back to a stable currencies, right? So if those stable currencies are suffering from inflation, how would you not? How would you not?
Yep. So that's where you actually include a certain amount of commodities into the basket that the peg is slowly tracking over time. And so if you include stuff like gold and actually a little bit of Bitcoin, the peg research team found that that's actually really, really helps during those inflationary events. But yeah, if it was just sovereign currencies, you're correct. It would just be like an index fund or an index of all these different global currencies, and you'd experience inflation probably it depends on what that aggregate is, but you include the commodities, and that's back to that conversation about inverse correlation, uncorrelated, et cetera.
Gotcha. So you mentioned a moment ago, various stable coins, having some issues and so forth. Obviously, Terra Luna, was in the news, made mainstream news. Let's just break that down for a second. What caused that to happen? Why was that an issue? What happened?
I'd love to get Bill's take on this. Your first shot at it now. I'm happy to hop in too.
All right. Okay, so what happened with Terra Luna? So it was known that they had a vulnerability as an algorithmic stablecoin. So regardless of how you would explain the technical details, the vulnerability or the chink in their armor was known, right? So this is an example of intense market volatility, right? The value of the collateral or the perception of the value of the collateral changed. And then some big player, okay, who knew both the vulnerability and how to get short and break things. By the way, we still don't know who that is, as far as I know, right? Could have been Uncle Sam himself. Broke Terra, okay? Basically made a big short sale.
Hold on, but wasn't Terra backed by Luna itself? So it was basically creating like this infinite loop of printing money?
Right, so yeah, that was the chink in the system, right? In other words,
that doesn't sound like a vulnerability. That sounds like poor design.
Okay, well, I mean, from the point of view of the guy that was shorting it and breaking it, he considered it a vulnerability. You would call it poor design as a product owner, which makes sense. But the bottom line is, somebody saw an opportunity. It was like a UFC fight, right? Like Luna leaned the wrong way and walked into a punch. Now, I'm sure the details of that I'll leave to Carter and Jonathan.
Yeah, I mean, so for those of you who don't know, the way UST worked is you're able to burn, to keep it really simple. You can burn $1 worth of Luna for 1 UST, right? And so whenever the stable coin went above peg, let's say it's trading at $1.02, this is a bad thing, right? Like we want it to be targeting $1. And so anyone in the world could go in, burn the dollar of Luna, mint out 1 UST, and sell it at $1.02, and that pushes it back to peg. That's what we mean by algorithmic. And so that expands the supply of the stablecoin, and actually it shrinks the supply of Luna. The inverse situation is what happens when it's under peg. If UST is trading at 98 cents, there needs to be a way to push it back to $1. And the way they did that is you could essentially turn in and burn your 98-cent UST for $1 worth of Luna. And so what you're doing there is you're shrinking supply, if you think of supply and demand curve, and you're able to push that back to $1. The thing is, Luna on the other end is getting minted during that contractionary event. If the demand for the stablecoin rapidly decreases, a bunch of UST is getting burned, a bunch of Luna is getting minted. And with normal degrees of volatility, this mechanism actually worked pretty darn well. Granted, there was some market makers involved on centralized exchanges that had to help, which is a long tail risk that ended up being very, very damaging. But yeah, those are some of the mechanics, and I think people are really giving up to a degree on algorithmic stables, and I think that the mechanism was good. It's just that they were fully reliant on it, and there's vulnerabilities there, and so people forgot that something like Terra Luna is a massive experiment. All of these stablecoin projects are experiments, and that was a heartbreaking experiment. My heart goes out to that entire community. But the data set from that crash, all the other stablecoin founders that I'm talking to, I mean, there's so much to be learned from it. And I guess my summary is that's the explanation of the mechanics. We should be careful about saying it doesn't work at all. It's just Luna got hit by a long tail risk because of very well-timed players that had deeper liquidity and had perpetual short positions and were leveraging some economic vulnerabilities. And now it's up to us as founders to say, what are those economic vulnerabilities? What can we keep? What should we not keep from the model?
Yeah, and Bill, I'm sure you've seen things like this play out through your history in Wall Street and so forth, and call it these attacks and so forth, when people find these vulnerabilities or poor design or whatever we want to label it. What do you think, from your background, like what do you see, because we're close to wrapping up here, what does the immediate future look like, you think, in this space? Not just stable coins, but just stable coins and call it, let's just say all of crypto to wrap this up. What's the short term look like here?
Okay, well, the short term is there's a problem with collateral. ETH can't be down 8 weeks in a row organically. There's forced selling somewhere. So someone is questioning the value of their collateral. Now that sounds a little grim. Well, let's do it this way. What doesn't break you makes you, right? So the lesson learned from Luna is that anybody in the stablecoin business, the first question they have to answer is, we're not Luna. We may be using an algorithmic mechanism, but we're not them. So that provides this really strong market-based sort of incentive to explain the value proposition, which I think Carter, and we were talking about Frax possibly,
Yes.
right? These guys can explain it. So in 1992, I was a kid watching George Soros break the EMS currency peg, right? He just broke it. And then that led to the euro. And the euro, say what you want about it, but it's to stop European nations in Western Europe from fighting each other. So their first experiment failed, but then the euro seems to be okay. They made something better. And after Luna and UST, somebody will make something better.
Yeah, I think when we look at stablecoins in 2022, I think the risk I'm seeing is people are so focused on stablecoins in DeFi products. And if we do not bridge stablecoins back to everyday in commerce, then we failed. Because that is where truly sustainable demand comes from for these systems. And that's at the heart of it. If it's not being used, there's less liquidity, there's less people believing in the system, using the system, and that introduces risk. So I believe for stablecoins to succeed, you have to have consumer privacy to be bridged back to Web 2 and Web 3, thus Shade Protocol, building Silk, building on Secret Network. If you haven't checked out the layer 1, you definitely should. And that's what I'm waiting on. I'm waiting for all the stablecoin founders to say, wait a second, maybe we've been doing this wrong. It seems the best place to get initial adoption is these decentralized finance products, but we have to be laser focused on going above and beyond that and bringing stablecoins to global communities, or else the mission was failed, in my opinion. So
Yeah, man, shopping, retail therapy, right? If you can do it with a stable coin.
Yeah, I definitely see stable coins as the evolution of loyalty points and in-network currency. I can see a world where you have every retail brand have its own stable coin, but as a consumer, you don't see it as a stable coin. It's just your, Amazon bucks, your whatever bucks, and it's just pegged. Anyways, great panel. Everybody, thank you so much for joining. Hope you're enjoying DecentralCon. Make sure you're tweeting at DecentralCon. Big round of applause, and thank you all. We'll see you soon.